Okay, let's just dive right into this explainer and completely peel back the shiny veneer of today's supposedly booming economy. I mean, if you just glance at the mainstream headlines right now, you'd probably think everything in America is perfectly healthy, right? Wages are supposedly creeping up, employment looks stable on paper, and the stock market is just absolutely soaring. But underneath that surface level prosperity, there's a totally different structural shift taking shape. We're looking at a financial reality built not on wealth creation, but on massive wealth extraction.
So you're seeing these S&P 500 record highs and low unemployment numbers, but there is a totally different reality unfolding in suburban strip malls across the country. Back in early 2026, while the broader market was just shattering all-time records, some of the smartest institutional investors out there were quietly pouring money into businesses that rely entirely on people running out of cash. Think about that for a second. When the ultra-wealthy start investing heavily in pawn shops, they aren't exactly betting on widespread prosperity. No. They are literally betting on household desperation.
To really get why this is happening, we have to look at an absolutely staggering figure. Over $1.2 trillion in U.S. credit card debt was recorded by the Federal Reserve in early 2026. This number completely shatters the illusion of middle-class stability. Because while employers might be reporting stable payrolls, consumer sentiment is practically collapsing under the sheer weight of everyday costs. The price of groceries, fuel, utilities, they've all significantly outpaced wages for folks sitting right in the middle of the income ladder. This kind of heavy financial strain, it doesn't show up in your standard jobs report, but man, it is glaringly obvious when you look at consumer debt. Now, what's really fascinating about this, and honestly a bit counterintuitive, is that between 80 and 90% of pawned items eventually get bought back by the customer. This proves we aren't talking about people permanently giving up their belongings. Actually, these are employed individuals. They're using pawn shops purely as a bridge to get from one paycheck to the next. The vast majority are returning to buy their stuff back, which means they have a steady income. The paychecks are definitely still arriving. It's just that the cash is disappearing way faster than it comes in.
And believe me, Wall Street has absolutely noticed this trend. They are rewarding pawn empires like First Cash Holdings with stock charts that literally look like they belong to some cutting-edge AI startup. Over a 12-month period ending in April 2026, First Cash, which, by the way, operates over 3,300 pawn locations, saw its stock practically double. It jumped from the low 120s straight up to a high of 227. They reported a massive 26% jump in year-over-year revenue, and their total assets crossed the $5.4 billion mark. That is wild. It really highlights this dark, kind of uncomfortable contrast. When a massive software company grows, they're expanding into new countries or launching innovative new products. But when a modern pawn empire scales up, they achieve these staggering margins simply by scaling the financial desperation of everyday households. It's daily collateral and short-term loans. A $150 drill set gets pawned just to cover a sudden car repair. You multiply that exact scenario by thousands of suburban storefronts, and suddenly you've got a margin profile that Wall Street just cannot resist. So you might be wondering, who is actually walking through those neon-lit doors today? It's really not the outdated stereotype you might be picturing. We're talking about middle-income families making anywhere from $60,000 to $100,000 a year who have just hit an unexpected wall. For example, you have a pediatric nurse in Phoenix with a solid, steady job, bringing in her grandmother's inherited tennis bracelet for $400 just to fix a broken AC unit. Or an HVAC contractor pawning a $900 Snap-on socket set just to cover a Friday payroll gap because an invoice came in late. The absolutely crucial takeaway here is that the system isn't breaking down because people don't have jobs. It's breaking down because their cash just evaporates before the month is over. It's a question of timing. These new customers, they have pay stubs, they have 401ks, but at the end of the month, the math just doesn't work out. The credit card is maxed out, a traditional bank loan wouldn't clear in time anyway, and the bill is due today. It is a fundamental crisis of liquidity for the modern American middle class.
So how did we even get to this point? Well, to understand that, we have to look at the massive structural void left behind when roughly 5,400 traditional bank branches simply vanished between 2019 and 2023. You've probably seen this happening in your own town. Where there used to be a regional bank with a drive-through and a friendly teller, there's now, a pop-up shop or just a vacant lot. The traditional banking network is shrinking rapidly, and that is fundamentally altering how entire communities access capital. And this created the perfect storm. As 16 of the largest banks pulled out of these exact neighborhoods, high-interest pawn lending expanded directly into those very same zip codes. In 2024 alone, over 900 traditional bank branches closed down entirely. Take a look at places like Lithonia, Georgia, a middle-income suburb where massive banks like Wells Fargo and Bank of America systematically packed up and left. In their absence, the pawn signage along main corridors like Highway 124 didn't just stay lit, it completely multiplied. The pawn shop essentially became the replacement. This systematic withdrawal by the big banks accelerates the creation of what we call banking deserts. When a neighborhood becomes a banking desert, the median distance to the nearest branch can increase by up to 2 miles. That means quick, equitable, in-person banking is pushed farther and farther away from the people who actually need it most. It leaves this massive vacuum, cutting off access to fair financial services and forcing working families to make incredibly difficult, highly expensive decisions just to survive a minor financial emergency. But before they even reach the pawn counter, there's often this modern gateway, the buy now, pay later trap. Things like Affirm, Klarna, and Afterpay were sold to us as financial inclusion, right? But the reality on the ground is that these installment plans quietly max out a household's credit across multiple paychecks. Shoppers stack these plans, late fees pile up, regular credit lines hit a hard wall, and eventually they have nowhere else to turn. And consumers end up turning to pawn shops for one simple reason. Pawn shops ignore credit bureaus entirely. They only care about your collateral. Now, the executives running this alternate financial system, they literally call this consumer desperation a boost for their companies. Which brings us to the biggest plot twist of this entire explainer. We've established this massive shift toward high-interest, collateral-based lending for the middle class as a massive new growth story. But if this industry is booming so hard and the profits are just skyrocketing, who exactly owns it? Where is all that money actually going? Well, get this. Roughly 80% of these pawn operations are owned by institutional investors. Let that sink in. The exact same asset managers handling everyday 401ks are directly profiting from this cycle. You have Vanguard holding a 9% slice. You have BlackRock holding another 9%. The vast majority of these shares are owned by the most powerful institutional landlords on Wall Street. It's honestly a gut punch realization. The money that's supposed to protect your future, to secure the middle class's retirement, is sitting right there in the same system that profits when things get tight for them. Asset managers are helping people save for their long-term retirement while simultaneously taking those exact same funds and investing them into companies that extract wealth from those very same people when they're vulnerable and run out of cash on a Friday afternoon. And when you put these two systems side by side, the disparity is just devastating. Think about the cost of a $500 loan for 90 days. It's the same amount of money, same exact time frame. But because traditional banks have abandoned these neighborhoods, a borrower ends up paying around $300 in fees and interest at a pawn shop compared to maybe $15 at a traditional bank. We're talking about APRs anywhere from 60 to 240%. It's a staggering extraction of wealth. And this dynamic creates the ultimate yield trap. Remember how we said 80 to 90% of items are redeemed? The pawn shop isn't making its real money by selling your grandmother's bracelet or your tools. They are making their money on the repetitive fees. People are cycling through the exact same items over and over again to secure fast cash. They get locked into these massive fees, completely trapped in a cycle of high-interest debt that doesn't build any wealth at all. It just constantly drains it. So we've essentially built this hidden, two-tiered economy that is entirely dependent on the continuous financial strain of the middle class. For the top 20%, banks still act like normal banks. But for everyone else, this faster, wildly more expensive system has taken over, turning everyday financial struggles into an institutional growth asset. Leaving us with one terrifying final thought. If this system's massive profit relies entirely on working families running out of money every single month, what happens to our economy when those families finally have nothing left to pawn?